I'm Charlotte McLeod with investingnews.com, and here today with me is Joe Cavatoni, Senior Market Strategist Americas at the World Gold Council. Thank you so much for joining me. Great to have you.
Great to be back, Charlotte. It's always a pleasure.
Yes, really good to be catching up with you once again. And of course, we're here to talk about the latest gold demand trend report from the World Gold Council. Before we get into all of those details, I wanted to at least begin by mentioning the price, which of course continues to see really big momentum. When we spoke last during the summer, you mentioned how we were waiting for the next catalyst to move the price higher. And of course, there's a lot going on, but I wondered if there's anything that you would pick out that you think was that catalyst that we were looking for.
So I think that's a great question. It's a great place to start. Almost inconveniently, we have to keep refreshing slides every day because we keep hitting record highs. We might want to just start talking about it in a different context as a record-setting year in terms of the numbers of moments. But the gold price continues to hit these highs. And one of the key catalysts that we talk about was clarity around the direction of monetary policy from the US, which would be a spark for interest and bringing back the potential flows with Western investors. We got that rate cut the last time the FOMC met, 50 basis points. That's been a kicker that's moved Western investment back into play, but there's still more to come. I think we have a lot more items on the horizon, including an election, including another FOMC meeting, and a potential for another directional view from the Fed in terms of rates, but also just more to come and over the course of the next 6 months. So lots to unpack in terms of the gold market, but very, very exciting. And actually, the dynamic of demand this quarter has been quite telling as we see these tides shifting a bit, and we're seeing the demand come from areas that we hadn't seen it in the past first half of the year.
Okay, really good to get that overview. And now let's get into some of the details in the report. So it's a pretty interesting report. And just as I check my notes here, some interesting numbers. So a Q3 record for demand, and the value of that demand was over 100 billion for the first time ever. So that's quite large. It
That's
sounds like
exactly right.
as you started to mention there, the Western investors ETF demand was quite key. So they're waking up. So can you share some details on what started to drive that?
Sure. So again, to recap what you've talked about, we've seen a record volume level in terms of the demand, and we've also seen a record 1,300 tons roughly coming into the quarter. So again, exceptional performance in terms of the demand profile as we categorize it. And when we talk about the Western investor, over the last few years with higher rates, the opportunity cost of holding gold has been high. So just to give a simple example, if you're looking at holding gold, which has a price performance characteristic to it, versus holding something with certainty to it, maybe cash balances of even 5%, you might find it better to be allocating to those cash balances. The overall holdings of gold in investment portfolios has been stable, but actually adding to the gold allocation has required that opportunity cost or that carry of cost to come down for the investor in the Western market, and that's what we're starting to see. We need to see a rate direction that's going south, which we're starting to see. We also need to see some clarity on the landing from an economic perspective. This will likely come in the form of a rate environment of real rates reducing and potentially a weakening dollar. That hasn't necessarily played out just yet, but it's on our mind, and it's actually bringing more investors back to the table. We think that there's more to come. We think that there's opportunity for larger allocations to come. But just to put it into context, at the beginning of the year, our worst moment in terms of outflows for gold-backed ETFs in the US, as an example, was negative 5 billion roughly, and we're currently looking at about 2.7 of inflows. So we've done a pretty substantial swing from negative to positive. And actually, that Western investment demand is coming not only in the form of ETFs, but we're also seeing some stability around the bar and coin market. It hasn't been an exceptional year, but it's still holding above its 10-year average in terms of bar and coin. We'll talk a little bit more about that if you'd like. But at the end of the day, what we're seeing is definite interest in terms of that monetary policy and the economic factors weighing in on why owning gold, but then also some geopolitical and political factors that are continuing to stay front and center for everyone and keeping gold relevant.
I think it's really helpful to have that context outlined. And I do want to talk a little bit more about the bar and coin demand. So it looks like in Q3, it was overall relatively stable, some slowdowns in China, Turkey, and Europe. So is it high prices that are making people a little less eager to buy in those locations?
Definitely high prices are weighing in. I think it's also an element of, again, in some of these markets, alternatives to the gold market. Turkey and China, large markets for coin and bar consumption. And actually, in the case of China, as an example, what we've been seeing is that there's been a bigger adoption of financial instruments and also pure gold consumption in the form of bars. So maybe larger allocations with better instruments. And in the case of Turkey, what I think we're seeing is just a general slowdown in terms of the overall level of consumption. And that's what we're basically getting a sense of in Germany as well. The U.S., though, again, is holding its own. I think certain retail outlets of trusted sources of gold, that includes places like Costco, can be contributing to some of that. But what we're seeing overall is when it comes to really the coin and bar market, probably holding off right now and slowing a bit relative to what we're seeing in some of the other bigger investment markets. But in the case of Europe, though, just to put more context into play, it has been a market where we haven't seen as much demand as maybe we would have expected. The European central banks were making rate cuts sooner than the U.S., and the dynamic still hasn't played out to see gold really rising. It is the one ETF market of all the markets that we track, the European bucket, where we're still seeing outflows, net outflows of about 5% of the total holdings in Europe. So not a major outflow, but still the shift for the Western investor in the European markets really hasn't taken hold just yet.
All right. And as we talk about some of these trends in the West, I wanted to throw in a question that's a little bit outside of the gold demand trends report, just because we have the US election coming up quite soon. It's going to be just next week. So the World Gold Council also actually did a separate report on the election and its impact on gold. And I think my main takeaway is, with election, the price doesn't tend to have a strong impact when we have these election years. But bar and coin demand tends to increase when we have a Democrat presidency. So I wondered if you could weigh in on that and if the trends that you identified in the report seem to be playing out in this election cycle.
That's a great question and a perfect time for us to talk about it in lieu of the fact that we're just around the corner from the election on next week. So here's how investors should think about gold and its response to the lead up to the election itself and the election results. Most of the rhetoric is going to be around what the possibilities could be on the back of a win from either candidate. A lot of that is being guessed and priced into the gold price, but the actual win itself has little or no impact on the price of gold on the short term. Our data supports the fact that it's really taking a step back. And while we might see an increased level of bar and coin demand with a Democratic win on the back of maybe an increased concern around higher taxes or an inflationary type of an environment, or maybe lower bar and coin demand if a Republican wins, it's not momentum enough or it's not substantial enough in terms of its flow to impact the price dramatically. Where they will have impact, or the election will have impact, is on how policies will develop. That tends to show itself up 6 months or so post an election outcome, when policies can be discussed, clarified, and potentially started to be implemented. And that's why we think that 6 months into the election outcome is when you're going to start to see more of an effect on the gold price from the outcome than the moment. There might be, with emotion that goes along with this election, there might be some increased levels of volatility. There may be some reaction and people looking to position around things. And we might even see that globally in terms of some of the central bank behavior, some of the investors offshore who are looking at the U.S., looking at what's going to happen, how they're going to be, how they're going to be impacted by the fiscal challenges that the U.S. is facing. But overall, you're going to see time to tell and exactly how that'll play out as a policy that'll lead to overall impact on the gold price. So we put a 6 month window on it to say to people, it's not over just on November 3rd or 4th or 5th or 6th or 7th. It's 6 months out you need to keep an eye on and pay attention to how policies develop.
Okay, so I'll make myself a note for 6 months from now when we catch up then, and we'll check in on how that's panning out there. Okay, so that was a little detour from the current report, and we'll go back to that now and take a look at central bank gold demand. So I think everybody's familiar with how central bank demand has been very strong in the last couple or few years. It sounds like in Q3 there was a little bit of a slowdown, but the takeaway seems to be that this is still going to be quite a strong year for central bank gold demand. So I wondered if you would pick out any significant buyers or sellers that we should be aware of.
So, a couple of key points to make. You're right to point out the fact that we are seeing some slowdown. The first half of the year indicated that we were on track to have yet another looking like another record year for us. But what I think is important to note, 2022, 2023 have been remarkable years for the central bank demand. So even while we're not necessarily setting another level of record performance, we're still seeing substantial flows in the central bank community. It remains concentrated in the emerging market central banks. Many of them are based in Asia, but I think that's the key to note that central banks are still at the table. The rationalization of concerns around inflation risks, concerns around homegrown inflation risks, concerns around having a liquidity tool in their toolbox. All of these factors remain very high. Their outlook for the U.S., the dollar, the U.S. based assets that they potentially hold in their portfolios, all factors that are in play, geopolitical tensions, etc. So you're still seeing substantial buying from the likes of Poland. You're seeing Turkey. You're seeing India, as an example, just announcing today that they've moved another a large portion of their gold holdings back home to India. So these are all examples of central banks that continue to be active and at the table. The one notable central bank that's been somewhat quiet in terms of their actual reported holdings and activity has been the PBOC in China. So we'll see what plays out with that, but ultimately, there's still quite substantial demand coming from the residual emerging market central banks.
Okay, it's really good to get that overview, know that they are still at the table there. So, if we shift over to jewelry demand, this was when we had spoken in the summer, just something that you said you'd be watching because often when the gold price is higher, we see a pullback in jewelry demand, which it sounds like did happen to an extent in the third quarter. So, anything that you would pull out on the jewelry side for investors to know about?
Yes, I think the key thing to remember is jewelry as a source of demand for gold. The two largest markets continue to be China and India. Over the course of the summer and into the fall, there were tariff and tax changes that were implemented in the Indian market. That gave it a good performance, up about 10% over the quarter to quarter, and actually year over year, I should say. So India has been the standout, even in a market where, as we've described, high prices tend to have people step back away from jewelry demand, which is what we saw in China. India was the standout simply because of that increased tariff. Now, the question is whether that's going to be a sustained type of performance or if that's something that's going to be somewhat short lived. We're moving into auspicious times of the year for many different countries, so we'll see how things play out in that direction. But right now, our expectation for jewelry and fabrication of jewelry remains conservative, and we're expecting those numbers to continue to be, at best, flat to modest growth, but most likely slowing down into the next quarter and into the end of the year.
I want to throw in as well at least a small question on technology demand for gold. I know this is not as large a part of the market, but one thing that stood out to me in the report is that Q3 tends to be a stronger quarter for technology demand for gold. So I wondered if you could talk about why that is and what you're seeing there.
Yeah, so I think overall, in terms of the technology space, it's still a small component, but I think it's actually an interesting one because I think with some of the more modern technologies, they tend to seem and tend to be a little bit price insensitive, or I should say, less sensitive to the price of gold, so they continue to look to consume it. So I think the use of gold in AI and in chip manufacturing continues to be consuming gold, and that's actually been exciting and interesting because it's not the largest component of gold that tends to be, you know, impactful and noted. But you're right to point out the fact that it's been a strong section. It's the piece that's least understood. But third quarter tends to have the demand coming into the end of year as they stock into manufacturing going into the end of the season and so forth. And I think that, quite honestly, our expectation with respect to technology is it continues to look like it'll have a strong run, but ultimately it's going to be so small as a component of the broader demand profile for gold that actually we think that it's not going to be enough to really be impactful on the price over time. But it is an interesting section, and I do think it's actually quite cool to keep it in the mind of our investors and your audience to understand that it is still, in that sense, a commodity.
I think it is. I think it is interesting and good to keep in mind. I also want to take at least a brief look at the supply side. So it looks like in Q3, supply up 6%, which I believe was a new record. I wanted
Yes.
to ask, when we get higher gold prices like this, do we tend to see much of a supply response among the miners?
Well, I think the miners are definitely reacting and producing. I think we're actually comfortably well above the new all-in sustainable cost levels that they tend to watch and produce against. And I think that actually for us at this stage, we're seeing these record numbers coming through. It's a strong environment. The question is, will this be a trend that we see for the long haul, or is this something that's going to, over time, is the capacity coming on fast enough to keep pace with these record levels? That's a wait and see discussion for us to take a look at over the next 2 to 3 years. But I think at this stage, you know, with the production as it basically is being published today, you're seeing diverse sources of the gold market production coming online in terms of Canada, African nations, also Australia. And I think it's actually been exciting to see that, yeah, we've got a record setting level of production, and actually mining companies are doing well with it.
Definitely. All right. I think we've covered many of the points in the demand trends report. We've talked about a lot of the factors that are moving the gold market at the moment. I think that probably the next time we're speaking is going to be in 2025 because we've only got 2 months of 2024 left. So before I let you go, I would just ask if you had any other points that you'd highlight from the report, but also looking forward into the end of this year, into next year, what factors are you watching most closely when it comes to gold?
Sure. So, just a couple of additional points from the report to highlight. I think again we're keeping a close watch and eye on those Western investors and the activity that's going to continue to play out there. Jewelry again is a space that we're watching kind of closely and trying to make sure we understand the impact there and the speed with which the Eastern investor continues to remain at the table. And we've talked a lot about the Western investor, but ETF flows, as an example, in the Eastern markets continue to be at record-setting levels as well. One point on the supply side we didn't talk to, which continues to be a growth area, is when we do see these higher prices and maybe that slowdown in jewelry, you tend to see a bit more recycling take place. And that's actually something that's come through again in third quarter. So let's see if that continues to be a trend as well. And as we look into the end of the year, the catalysts that we've been talking to, the election, you've got another Fed report or Fed meeting that's going to take place shortly after the election itself, and ultimately, a lot of political, geopolitical tensions and policy dates that are going to start hitting the radar. This week alone, we've got a lot of data coming out around the U.S. market, so expect a little more volatility in the gold price between now and the end of the year. I think many of the analysts are still kind of refreshing and looking at where their new highs could be in terms of the level. So we're still very, very comfortable with the case for gold. We're still seeing that as a global, rational reason for gold to remain strong and at the forefront of many investors' minds. And I think we just need to keep a close watch on some of these big moments as we approach the end of the year. And hopefully we'll see things calmly and comfortably fall into place and continue to be the right kind of an environment for the strong gold market.
I think that's a nice hope for us to end on. Thank you so much for going through what's happening in the gold market, and I do hope to check up with you again soon. This was
It's
great.
great to be here, Charlotte. Thank you very much.
Thank you. And once again, I'm Charlotte McLeod with investingnews.com, and this is Joe Cavatoni with the World Gold Council. Thank you for watching. If you like this video, make sure to hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.